We've known for a long time that 2025 would be an active year for tax legislation. For one, many of the tax rules we've been working under for the last decade or so were set to expire at the end of the year. It's also the first year of a new presidential administration, when there's often a special focus on enacting items that were part of the campaign platform. The net result of these items is that we have a new set of tax laws that are very broad in scope and contain a wide array of changes that will affect every taxpayer in some way. In this video, we'll discuss important aspects of what's being referred to as the One Big Beautiful Bill Act. We'll discuss some of the laws that were set to expire but instead were extended or even expanded upon, as well as a few interesting new additions to our tax code. We'll cover a new type of savings account and some important changes for business owners as well, leaving you plenty of important things to discuss with your Baird financial advisor. The 2017 tax bill, known as the Tax Cuts and Jobs Act, included a sunset provision that said most items of that bill would expire at the end of 2025, bringing us back to the rules that were in place nearly a decade earlier. Instead, this new bill makes virtually all of those items permanent parts of our tax code, while modifying a few things along the way. Most notably, this includes keeping our current tax rates and brackets in place, thereby avoiding an increase in tax rates of as much as 4% across all income levels. The enhanced child tax credit will not only stay in place, but was increased to $2,200 for this year. The same is true of the lifetime gift and estate tax exemption, which will increase to $15 million per person in 2026 rather than falling to less than half that amount. On the other hand, the alternative minimum tax rules will be tweaked a bit in 2026, leading to an expected increase in the number of people subject to this additional tax. There were several significant changes on the tax deduction side as well, giving taxpayers new opportunities to reduce their taxable income. For example, the standard deduction has been at a higher level ever since the Tax Cuts and Jobs Act, but it will increase again in 2025, allowing taxpayers even more tax-free income. For itemizers, however, the reductions that have been in place for the last several years will be made permanent, albeit with a few tweaks. The most notable exception to that is the increased limit in the deduction for state and local taxes, known as the SALT deduction. The old $10,000 limit has been temporarily increased to $40,000 beginning this year and running through 2029. However, this increase is subject to a phase-out for most taxpayers with income between $500,000 and $600,000. This phase-out creates a window where taxpayers with income within that range could see an effective tax rate on those dollars of as high as 45%. Phase-outs of tax benefits like this make tax planning with your Baird financial advisor all that more important. This is especially true when you consider many of the new changes in this bill are subject to similar phase-outs, as we'll discuss more in the next section. This bill wasn't just about extending old law into the future. There are several changes that will affect a wide variety of income levels, age ranges, and more. To begin with, there are new rules that allow employees to deduct qualified tip or overtime income that would otherwise be taxable to them. There's also a new deduction for interest paid on auto loans originating this year to purchase cars assembled in the U.S. All three of these deductions are only available for 2025 through 2028 and come with maximum deduction limits. They also all come with income phase-outs, meaning taxpayers with higher levels of income will find it harder to qualify for these new deductions. A fourth new deduction is being called the senior deduction, as it's only available to those age 65 or older. It's a $6,000 deduction per person, and like the others, it's only available for 2025 through 2028, and it too is subject to a phase-out for those whose income is above a threshold. Because of the phase-outs of these new deductions, taxpayers will have to pay extra attention as their income approaches these ranges. Even doing something like a Roth conversion or realizing a capital gain can cause you to lose the benefit of these deductions, increasing the effective tax cost of that action. All four of these new items are available to taxpayers regardless of whether they claim the standard deduction or they itemize. A fifth new item, a special deduction for charitable contributions, is only available to those taxpayers who claim the standard deduction. This is not subject to any income phase-outs, however, and will be a permanent part of the tax code beginning in 2026. Speaking of charitable gifts, there are other changes that will affect the way people think about their giving this year. Beginning in 2026, charitable contributions will only be deductible to the extent they exceed a certain percentage of your income. And there will be a new cap on the total value of all itemized deductions, but only for those in the top tax bracket. Because of these two changes, many taxpayers will consider accelerating their 2026 charitable gifts into 2025 in order to maximize their tax value. An easy and effective way to do this is by making those gifts to a donor-advised fund. Your Baird Financial Advisor can help you establish and fund one of these important charitable giving vehicles. Another new item in this bill is a special savings vehicle available for minor children called a Trump account. These new accounts are a lot like a traditional IRA in that earnings in the account are tax deferred until they're withdrawn, although they come with lower contribution levels and can only be made until the beneficiary reaches age 18. Children born in 2025 through 2028 can be eligible for a special $1,000 government contribution to these accounts. Now, these accounts can't be opened until July 2026, so stay in contact with your Baird Financial Advisor as more details become available. Also for minors, the rules on 529 accounts have been expanded once again, allowing new opportunities to use these funds to pay for K-12 expenses this year, with an increased spending limit beginning in 2026. While most of the attention has been paid to the changes directly affecting individuals, there are several changes that business owners should be aware of. Most notably is the ability to deduct 100% of the cost of qualified property in the year in which it's purchased, an important enhancement to the bonus depreciation rules. The qualified business income deduction rules have been made permanent and even expanded a bit, making it easier for owners of pass-through businesses to qualify. On the other hand, the tax benefits available to owners of qualified small businesses structured as a C corporation have been enhanced as well. For those looking to start a new business, these two items will make the decision on what tax structure to use more important than ever. As you can see, this new bill contains a wide variety of changes, rules, phase-outs, and qualifications, and it can be difficult to understand how all these parts work together. For example, taking advantage of one planning opportunity could disqualify you from taking advantage of something else. Fortunately, your Baird Financial Advisor has access to powerful tax planning tools and an experienced team of wealth, tax, and estate planners who can help model the impact of these changes and identify planning strategies to consider this year and into the future. I encourage you to discuss these things with your advisor and make sure you're not missing out on any important planning opportunities.